If you're looking to get into real estate investing, then you might want to start out with what is an FHA mortgage loan. Plenty of real estate investors take advantage of this mortgage loan product because it just offers so much to people who are barely beginning their real estate investing journey. If you're looking to get started in real estate investing, then you might want to watch this video all the way to the end so that way you don't skip out on any valuable information that can help you out. If you're already a subscriber, then welcome back. But if you guys are new to my channel, my name is Ismael Sandiford. I'm a licensed realtor and I'm a licensed mortgage loan originator. And on this channel, we talk about personal and business credit, real estate, and other financial related topics. So if that's something you're into, then you're probably gonna want to consider subscribing. But without further ado, let's get into today's video. Okay, so first and foremost, FHA stands for Federal Housing Administration. Plenty of people think FHA stands for first time home buyer, but that is definitely not the case scenario. An FHA loan is a government-backed mortgage loan that allows you to put 3.5% down while having a minimum credit FICO score of at least 580. But the only way to obtain this mortgage loan is the home that you're buying has to be your primary residence. Otherwise, you will not qualify for this mortgage loan. Plenty of people out there think you need at least 10% to buy a home or even 20% to buy a home, but the truth is you can buy a home with only putting 3.5% down. Now, if you do have a credit score lower than 580, like anywhere from 500 all the way up to 579, then yes, you're gonna have to put 10% down, and that's only because you look like a risk to the lender. And if you're a risky borrower, then yes, you're gonna have to put more money down. But again, if you have a credit score of at least 580, then you only need to put 3.5% down. But not only can you buy a home with only putting 3.5% down and a minimum credit FICO score of at least 580, but you can also use this mortgage loan to obtain multifamily residence, a 1 all the way up to a 4-unit residence. So that means you can use this FHA loan to buy a single family residence, a duplex, a 3-plex, and even a 4-plex. But you have to live in one of those units in order to qualify for this mortgage loan again. One of those units have to be your primary residence. Otherwise, you will not be eligible to obtain this mortgage loan. And you have to live in there for at least 1 year. So imagine buying a 4-plex home, a 4-unit residence, while only putting 3.5% down. Isn't that crazy? Like, you can literally live in one of the units and rent the other 3 out. And another thing that a lot of people don't talk about is you can actually use 75% of the rental income to help you qualify for a larger loan amount. So for example, if you're pre-approved for a mortgage loan of about $750,000 and the property you're trying to buy is $820,000, then if it's a multifamily residence, then like I said again, you can use 75% of that rental income to help you qualify for a larger loan amount, so you'll for sure get over the $820,000 in order to qualify for the home you're trying to buy, the multifamily residence. FHA loans let you do 1 to 4 unit residences because anything after 4, like 5 and up, is going to be considered commercial real estate. 5 and up will no longer be considered residential real estate. But this FHA loan is designed to help low to moderate income families obtain a home and like actually make it affordable. So for example, if a property costs $500,000 and you obtain an FHA loan which allows you to put 3.5% down only, then that means you're putting $17,500 down. And whenever you buy a home, you're gonna have to pay something else called closing costs, which is usually 3% of the purchase price. So in this case scenario, again, if a home's purchase price is $500,000, then 3% of that is going to be $15,000 that's going to be needed towards closing costs. So that now brings us at $32,500 roughly in order to purchase a home that costs about $500,000. And make sure to watch this video to the end because in a bit I'm going to be talking about how to avoid paying closing costs up front so that way you only need $17,500 down and just pay that and that's it. So keep watching. Now the government doesn't issue these FHA loans, but they do insure them. Also, if you don't have any of the money to put down, then you can actually receive this money as a gift from a close friend or even a close relative. They can actually wire you the money for a down payment. And these FHA loans allow seller concessions all the way up to 6%. Now what in the world is seller concessions-ish? What is that? Seller concessions are closing costs that the seller has agreed to pay. How this would work is, let's say for example, a house you're trying to buy costs about $100,000 and you're pre-approved for $120,000. In the residential purchase agreement contract, you would write an offer of about $103,000 even though the property only costs $100,000 that he's asking for. But that extra $3,000, we're going to use that for the seller to credit us back because originally we were pre-approved for 120 grand. So he will give us our $3K back for closing because again, closing costs are usually about 3% of the purchase price, and in this case scenario, 3% of $100,000 is going to be $3,000. And a lot of people tend to do this method to avoid paying closing costs up front. So that same property that we were trying to buy for $500,000, if we get seller concessions, then they credit us for closing costs, then really out of pocket, all you're really coming out is about $17,500. But you can use these seller concessions for other things as well, like buying the rate down. There's something in real estate called a 2-1 buy down that you can do. Ish, what in the world is a 2-1 buy down? What is that? Good question. A 2-1 buy down is where you buy the interest rate down for 2 years. So for example, if you're at an interest rate at 7% and you get a 2-1 buy down, then the first first year, the rate is going to go down 2 points. So that now brings us at 5%. And the second year is going to go to 1 point down. So that's going to be 6%. And then on the third year is going to go back to 7%, which was the original interest rate. That is what a 2-1 buy down is. They also have permanent buy downs, 3-2-1 buy downs, and I'll save that for another video. And the technique on how to use this 2-1 buy down, hopefully within the 2 years that your rate is bought down, the rates will go lower so that way you can refinance your mortgage loan to a better rate. But another thing you can do with these seller concessions is pay off existing debt, such as credit cards. So if you have about $4,000 or $5,000 in credit card debt, then you can use the seller concessions to take care of that credit card debt. How neat is that? Now, to get approved for an FHA loan, the debt to income ratio is about 40 to 57% depending on what lender that you go with. Some lenders will require a 45% debt to income ratio, but other lenders will go a little higher, like all the way up to 57%. So it pretty much depends on who you go with as a lender. And also, if you guys are finding this information helpful, if you guys could do me a favor, hit the like button. I would truly appreciate that because it truly helps me out a lot. But anyways, this is a really good mortgage loan product, but what a lot of people don't know is that you're actually allowed only one FHA loan at a time. A lot of people and even real estate investors usually refinance out of FHA loans, and they usually want to get into something called a conventional loan, which I'll talk more about in a different video. But the reason they get out of an FHA loan into something called a conventional loan is because you're only allowed one FHA loan at a time, and a lot of investors want to take advantage of only putting 3.5% down in order to buy multifamily residences. So this is kind of like a housing hack that all realtors and all lenders and pretty much anybody that's in real estate knows already. This is like basic real estate investing 101. And you don't have to be a first-time homebuyer in order to obtain this mortgage loan. Literally, a first-time homebuyer is considered if you haven't bought a home within the last 3 years. That is what a first-time homebuyer is. And there is no limit on how many FHA loans you can receive during your lifetime, but again, you are only allowed one at a time. But if you're looking to obtain an FHA mortgage loan, then some things you will need is the last 2 years of your W-2s or 1099s. Also, your last 2 months of bank statements, 30-day pay stubs, a copy of your driver's license, and social security. That is typically what lenders will ask for if you're trying to get approved for a mortgage loan. And there are no income limits. Make as much money as you want. But one thing I will say is that there are mortgage loan limits, and that varies depending on what state and city that you live in. Like here where I live in LA County and Orange County, the loan limits are going to be $1,089,000. So anything after that, you would have to put more money down. But once you purchase the home, you're required to move into the property within 60 days after closing escrow. And the FHA guidelines say that you must live in the property for at least 1 year. But once a year passes, you can choose to rent out the property to a tenant and have them pay your mortgage while you're just sitting back collecting all of the equity. And real quick, for those that don't know what equity is the difference between what your home is valued at nowadays versus what you owe left on your mortgage loan. So for example, if you have a property that's worth $400,000 and you only owe $250,000 left on your mortgage loan, then you, ladies and gentlemen, have about $150,000 worth of equity. And you can choose to obtain this $150,000 in 3 different ways. You can sell your home and collect all of that equity, although you have to live in the property for at least 2 years in order to not pay capital gains. So in other words, not be taxed on that money. And another thing you can do is something called a cash out refinance, which I'll talk about in a different video. And another thing you can do is a HELOC, aka a home equity line of credit, which I'll talk about in another video. So if you haven't subscribed already, please do so if you want to find out what that is. But anyways, another thing that is needed to qualify for an FHA mortgage loan is you have to go through an appraisal. And this is only to make sure that it meets government standards for both health and safety. An FHA appraisal is different from what a home inspection is. So for example, if a home is broken in that home you're trying to buy, then it will not pass FHA guidelines. So in other words, you won't qualify for that mortgage loan. The seller would have to fix that before the appraiser looks at it, so that way it can pass FHA guidelines. And another thing needed to qualify for an FHA loan is the property cannot be a flip. So for example, if an investor comes in and buys and then renovates the property and then puts it back on the market, then you have to wait at least 91 days in order for you to buy that home. You will not be able to buy that home immediately, at least not with an FHA loan. And this is only in place to protect you as a buyer. Basically, the government just wants to make sure that you're not paying more for a home that was just acquired by the seller at a much cheaper price. And here's another big thing, so listen up. If you owe the IRS taxes, then you cannot get this loan unless you are on a payment plan. If it's your first time in that year owing the IRS, then you only need proof of one payment of you making payments to the IRS. But if you've been owing the IRS for multiple years, then you need to show proof of you at least making 3 consecutive payments. And that has to be done in a row. One big advice I would give about FHA loans is before you get married, buy a multifamily residence, like a 3-unit or even a 4-unit, and then have your partner get an FHA loan and have them do the same thing as well. Because once you guys get married, the Federal Housing Administration views both of you guys jointly. So what I'm I'm saying is, if both of you guys are married now, then both of you guys can only receive one FHA loan at a time. You no longer can get them individually because you guys are joint now. But if you already have your property and then your partner already has their properties, then when you guys get married, then you could potentially have up to 8 units together. And that's basic real estate investing 101. All the realtors, all the lenders, and anybody that's in real estate pretty much already knows this. And bonus information that I'm going to be leaving you guys with is, if there's multiple people on the mortgage loan, then lenders are going to go with the person that has the lowest credit score. So make sure everybody's credit score is good. It's not like renting a home or an apartment and you can just use somebody else's credit score. It doesn't work like that. But anyways, that'll wrap it up for today's video, guys. If you guys are interested in buying a home without putting any money down, then I made a really good video not too long ago. I'll link it down in the description below, talking about 4 ways that you can buy a home without putting any money down. So if that's something you're into, then feel free to browse the channel or just click the link in the description below. But if you guys made it to the end of the video, we are at 13,414 subscribers at the time of this recording. So I do appreciate all who watch. I do post every Sunday, Wednesday, and Friday. So if you guys haven't yet, don't forget to like the video and hit the notification bell so that way you guys can get notified every time I post a video. Again, I talk about personal and business credit, real estate, and other financial related topics. So this is your one-stop shop. I talk about how to get high limits on your credit cards. I talk about how to even get business credit. I talk about like a lot of real estate topics, mortgage loan topics. So if that's something you're into, then I would definitely consider subscribing. And again, for those that don't know, I'm also a licensed realtor here in Southern California. So if you're looking to buy or sell or have any questions in regards to real estate, then all my information will be in the description below. And I'm also a licensed mortgage loan originator. So if you're looking for funding when you're trying to buy a home, then again, all my information is in the description below. I hope you guys found any value in this information, and I will see you guys in the next video. Thanks for watching.